Where should you invest $10,000 today? That's probably not the worst possible question about investing, but it's pretty close. Hi, I'm Steve Wershing, CFP. Welcome back to 30-Minute Money. You know, there's a lot going on in the world right now, and especially in times like these, people look for investment opportunities. And one of the most popular questions out there, one of those clickbaity things that you will see all the time is, where should you put money today? What's the best possible investment? Where should you put $10,000? And that question totally misses the point when it comes to investments. It's great at attracting clicks and attracting attention and to suck you into a possible trap because it has a lot of appeal to two basic instincts. One is the instincts of the opportunist, which is to say, hey, there's a lot going on. There's probably something that's undervalued or that's going to explode in value or something like that. And so, you want to be in on that. Or it appeals to people who have concerns or are scared about what's going on, and they want to potentially protect what they have from going down or to offset other things that may be going down. But one of the most important rules you can follow in investing is to have a discipline and to stick to it. Most of the biggest investment mistakes are emotional. They're based on emotional decisions. And one of the big things that separates professionals from amateurs in the investment world is that professionals have some kind of a system that they diligently stick to, and amateurs do not. Amateurs either make decisions they know are emotional, or because they don't have a discipline that they stick to, fall into making emotional decisions without realizing it. The oversimplified one that you may see if you read up on this stuff is that cycle of greed and fear, two of the basic emotions that we just sort of alluded to before, although they act at exactly the wrong times in the cycle. And so when the market is going up, or any investment in particular is going up and up and up, and it looks like trees grow to the sky and there is no upper limit, many people say to themselves, I want in on that. I want a little piece of that. And so they start putting money in. Of course, they start putting money in when those investments or the markets make headlines about just how much they've gone up, which should be a danger sign to you. Anything that's got that relentlessly good news about it, it may very well be in for a turn, because the markets are cyclic, like a lot of things in the world. They go up and they go down. And so when everybody starts talking about how much the market has gone up, how much an investment has gone up, and how it may just keep going seemingly forever, that should send you running for the hills. But people respond to the greed and they want in on it too. Similarly, when the market does turn and starts dropping like a rock, one of the most natural things to do is to want to get cover, is to want to get protection from those falls. And so and by the time it reaches the popular media, by the time you see it on popular websites or in magazines, and they start running stories about, it's never going to come back, or it's going to continue falling forever, or, things are going to be going to zero, as people start internalizing that message, the feeling that they get is, listen, this is just more than I can deal with. Take me out. When it feels safer, I'll get back in. And of course, that typically is near the low of the market. And so the cycle of greed and fear persuades people, unfortunately, to buy high and sell low, which is exactly opposite what you want to do. It can also be a little bit more subtle, that when times are a little bit more stable than they might be. For example, right now we have in political conflicts going on around the world. We have inflation taking off. We have all kinds of things that can rattle people. And so there's a lot going on. But even when that's not the case, a lot of people may feel like they can read the economic tea leaves and get some idea of where things are going to be going, and they will make decisions based on that. But without a discipline, they're making decisions based on emotion, and more often than not, it will lead them astray, lead them down the wrong path. And so how can you invest with discipline? Well, there are a couple of basic ways. The most basic way is to figure out what is the right blend of investments that you should have, and the ones that we use are stocks, bonds, cash, real estate, and commodities. And what, based on where you are in life, how far away you are from your goals, what your risk profile is, you can figure out how much of your portfolio should go into each of those kinds of investments, what the allocation of your portfolio should be. And we come up with a pie chart that is, this much of it should be stocks and this much of it should be bonds, and et cetera, et cetera. And so one way of having discipline is to figure out what that is for you at your stage of life, given your goals and risk profile, and then to rebalance it to that and to stick to that for the long term. So regardless of what happens in the markets, if the markets go up, if the markets go down, you'll stick with that pie chart. Although if they do go up or down, you may rebalance back to that pie chart. But you don't make decisions outside of that pie chart. That's one way of doing it. Now, I'm more of a believer that you can in fact follow trends, that you don't necessarily have to just stick with that without thinking about it, just blindly sticking to a particular asset allocation. Although if you don't have a professional who is following a disciplined system, that's a good one to have. So I'm not saying that that's the worst system. It's actually a very good system. But here, when we manage money, there's a tactical component to what we do. We buy certain research services, and we follow technical indicators, and we follow those same indicators over the long term. And so we will stick to a long-term allocation, that long-term pie chart, until we see specific technical indicators flipping from one side to the other. And if enough of them do that, we will make adjustments in the portfolio. We won't go hog wild, like we won't go entirely to cash or entirely to internet stocks, but we will make a little adjustments, because we believe that you can see trends develop, and if you can step out of the way when things are starting to slide and it becomes evident, and then you can step back into it as a trend is clearly on its way back up, that you can add a little bit to a portfolio. But again, we don't just look at the markets and try to make those guesses based on emotion. We have very specific indicators, and we can look back at the history of those. And that's why we believe that a system like that can add a little value and work. But the point is that it's a disciplined system. We're not making it up as we go along. Recognize that markets and portfolios will always go up or down. You don't want to make any decisions because they went up or because they went down. The important thing is that you either stick with that pie chart or that you follow specific indicators, because there will be nothing that you can do to prevent your portfolio from going up and down. And that's okay. That's in the normal course of affairs. That's how the world works. It's not necessarily an overly good or bad thing that your portfolio has gone up or gone down, because even a well-disciplined approach will do that. So one of the most important things that you can do when you're looking for how to put money to work or how your portfolio should be positioned right now is to have a system that you adhere to. Avoid emotional decisions or deviating from that system because of emotions. Have a discipline, have a system, and stick to it. And it's much more likely that things will turn out well in the long run. We also are, right now, as I'm recording this at the beginning of March, deep into tax season. You can still take advantage of last year's tax bracket by depositing some money into an IRA. And one of the big questions is, should you put it into a traditional or a Roth IRA? The traditional that you get a deduction for now, but you pay tax on later, or the Roth that you put in after tax now, but comes out tax-free in retirement. Well, to help you, we've got a couple checkpoints that you can compare to your situation and decide which is better for you. So if you go to focusedwealthadvisors.com/Roth IRA, you can download a free guide to help you decide whether your deposit for last year is better being put into a traditional or a Roth IRA. That's focusedwealthadvisors.com/ROTHIRA, Roth IRA. I'm Steve Wershing, and thanks for joining me on 30-Minute Money.